Think of the biggest companies in the world: Apple, Microsoft, Amazon. Now ask a simple question. Who owns them? Not who runs them. Who actually owns the shares? For a very large number of them, the answer is the same handful of names. And the biggest of those names is a company most people have never heard of, headquartered in a Pennsylvania suburb that has never advertised itself as powerful. It is called Vanguard. Here is the scale of it. In 2017, researchers at the University of Amsterdam published a study in the journal Business and Politics. They looked at the 500 largest public companies in America, and they found that 3 asset managers, BlackRock, Vanguard, and State Street, were together the single largest shareholder in 88% of them. Not a few of them, 88%. Which naturally leads somewhere uncomfortable. If one company sits at the top of the ownership pyramid of corporate America, then somebody sits at the top of that company. Somebody owns Vanguard. And this is where the story stops being what you expect.
Because Vanguard is owned by its own funds. That sounds like a riddle, so let me say it plainly. There is no founding family holding a controlling stake. There is no private equity firm. There are no shares of Vanguard trading on any exchange. You cannot buy one. The company is owned by the mutual funds it operates, and those funds are owned by the people who invest in them. So if you hold a Vanguard index fund, in your pension, in your retirement account, you are not just a customer. You are, in a small and very real way, one of the owners. The pyramid loops back on itself. Now, that could be a piece of trivia. It isn't. It changes the arithmetic of the entire business. Every other asset manager has 2 sets of people to serve. There are the clients who want low fees, and there are the shareholders who want high profits. Those 2 wants pull in exactly opposite directions because the fee is the profit. Vanguard only has the first group. There is no outside shareholder waiting for a margin, so the company runs its funds essentially at cost, and when it finds a saving, that saving has nowhere else to go. It goes back into the funds as lower fees. This was deliberate, and it very nearly didn't happen. Vanguard began operating in 1975, set up by a man called John Bogle. A year later, he launched something new, the first index fund available to ordinary individual investors. The pitch was almost insultingly simple. Stop paying experts to try to beat the market. Just buy the whole market and keep the fees. Wall Street's reaction was not enthusiasm. Critics called the idea un-American, a guaranteed route to mediocrity, an admission of defeat. Bogle hoped the launch would raise between $50 and $150 million. It raised a little over 11. He later described it, in his own words, as an abject failure.
But the structure had a quiet engine inside it. Lower fees attract more money. More money means more scale. More scale spreads the fixed costs thinner, which lowers the fees again, which attracts more money. Round and round for 50 years. That $11 million failure grew into a company with more than $11 trillion under management, over 50 million investors, and 465 funds. The abject failure became the default way that most ordinary people in the developed world now own shares. So, is this the part where I tell you a shadowy cabal runs the world? No, and it matters that I don't, because the truth is more interesting. Vanguard does not own those shares in the way you own your phone. It holds them on behalf of millions of individual investors, teachers, nurses, retirees, people with a workplace pension they have never once logged into. The economic ownership is theirs, spread across tens of millions of people. But there are real questions here, and they are not settled. An index fund cannot sell a company it holds, no matter what that company does, because the index says it must own it. That makes these firms permanent shareholders in a way the market has never seen before. And permanent shareholders still get to vote on directors, on pay, on mergers, across thousands of companies at once. Whether that concentration of votes is healthy is a genuinely open argument among economists, and anyone who tells you it is obviously fine or obviously sinister is skipping the hard part. But strip away the scale, and there's something useful underneath. Vanguard did not become the cheapest by being the most generous. It became the cheapest because of who it had to answer to. Nobody was standing behind it demanding a bigger margin. The structure produced the behavior. So when you are handing your money to any institution, a bank, a broker, a fund, an insurer, the most useful question is rarely what are the returns. It's this: who does this company actually answer to? Because whoever that is will be paid first. If that was useful, subscribe to Moneyverse. We take one piece of the financial system apart every week, and we tell you how it really works.